All right, let's get right into it. When you think of bonds, what's the first word that comes to mind? Probably safe, right? Or maybe boring. But what if I told you there's one single unbreakable rule that makes the entire bond market tick, and it's not what you'd expect? Once you get this, it changes everything.
So what is this golden rule? I'm talking about a concept that's so fundamental, it's one of the most tested ideas for financial pros. And for anyone who just wants to understand how money and markets really work, well, this is absolutely essential.
And here it is, the big reveal. When interest rates go up, the price of bonds that are already out there goes down. And you guessed it, when interest rates fall, bond prices rise. They move in opposite directions. The best way to picture it? A seesaw. One side goes up, the other has to come down. That's it. That's the unbreakable rule.
Okay, but why? Why on earth does this happen? It seems kind of weird, right? To get to the bottom of it, we need to do a quick anatomy lesson. We're going to break down what a bond actually is, looking at its core building blocks.
First up, every bond has what's called a par value. Just think of this as the price tag on the loan. It's the amount the bond is worth on paper, usually a nice round $1,000. And it's the exact amount you get paid back when the bond's term is over. Simple.
Next, we have the coupon. This is your reward, the interest you earn for letting someone borrow your money. Now, here is the absolute key to this whole thing. That coupon payment is fixed. It's set in stone the day the bond is created, and it does not change. Ever.
So, let's make this real. You've got a $1,000 bond with a 5% coupon. That means you're going to get a check for $50 every single year, no matter what. That $50 payment is locked in, guaranteed.
And this is exactly where the magic of the seesaw happens. Okay, stick with me. You're holding your bond that pays 5%. But then the wider economy changes, interest rates rise, and suddenly brand new bonds are being sold that pay 6%. Now, who in their right mind would pay you full price for your 5% bond when they could just go get a new one that pays 6%? Nobody. So to make your old bond attractive, you have no choice but to sell it for less than you paid. Its price has to fall to compete. See? That's the seesaw.
So, if the price of the bond is always moving around, that 5% coupon doesn't really tell you what you're earning anymore, does it? This is where we need to talk about a little something called yield. Yield is how you measure your real return.
Now, there are a couple of ways to slice this. You've got current yield, which is just a quick and dirty snapshot. You just take the annual interest and divide it by today's market price. But the one that really matters, the big one, is yield to maturity, or YTM. This is the whole shebang. It calculates your total return, factoring in all your future interest payments, plus the profit or loss you'll have when you get that $1,000 back at the end. It's the complete picture. And look, don't just take my word for it. It's universally agreed upon that YTM is the most comprehensive measure out there. It's what the pros use, because it lets them compare any two bonds on an apples-to-apples basis. It levels the playing field completely.
Okay, so we've established that bond prices move. But do they move just a little bit or a lot? The answer is, it depends. This sensitivity to interest rates is called, fittingly, interest rate risk. And there are two main dials that control just how wild that seesaw ride is going to be. And here are those two dials, maturity and coupon rate. The rules are actually pretty simple. The longer a bond has until it matures, the bigger its price swing. And this one might seem a little weird. The lower its coupon rate, the bigger its price swing. So, long-term, low-coupon bonds, those are the ones on the wildest seesaw ride.
Just think about it for a second. If you have a 30-year bond, you are locked into that fixed payment for decades. That's a long time for your bond to look uncool if rates go up. And if its coupon is already low, most of your expected return is tied up in getting that $1,000 back way, way in the future. That makes its price today super sensitive to any changes.
Now, of course, interest rate risk isn't the only thing to worry about. You also got stuff like credit risk, the chance the company just can't pay you back, or inflation risk, which is the risk that your fixed payments won't buy as much stuff down the road. But for our purposes, that interest rate seesaw is the star of the show.
Phew, okay, that was a lot. But we can boil it all down into a super simple cheat sheet. If you remember nothing else, remember these 3 rules.
Rule number 1, the seesaw rule. Rates up, prices down. Got it? Rule number 2, the maturity rule. The longer the time, the bigger the price swing. And rule number 3, the coupon rule. The lower the coupon, the bigger the price swing. That's it. That's the core of bond pricing and risk, right there.
So let's go back to where we started.
The next time you hear someone call bonds a safe investment, you'll know the truth. They're not without risk. They're in a constant, delicate dance with interest rates. And now, you know the steps to that dance. So my question for you is, how does that change the way you look at things?